Well, thanks for tuning in to yet another conversation of Alpha Strategist. It's a note that the Motilal Oswal team writes, and you know, moving in from multi-asset portfolios 3 months back to showing confidence around earnings to now talking about a topic which they title as Albatross Gliding. And until I read Albatross Gliding, my opinion was always that an albatross around your neck is the only way I've used that term, and that's a bad one. Now we know that it can be used positively as well. So on that positive note, let me welcome in both our guests to try and talk about this note. Gentlemen, thanks for taking the time out. Ashish, I'll start off with you. What prompted this title? I'm intrigued to know that.
Well, I think it's a continuation of our earlier notes. We've been last couple of sessions, if you remember, we've been clearly bullish on equities, and we've been saying that the earnings are coming through, the fundamentals are looking extremely good, and now we are in a situation where we are gliding or cruising. And albatross is a bird which has a very elegant way of gliding. And India as an economy and as a market is standing out, which is what we thought it should do early on in the year. So really good times, and it's being acknowledged by flows as well. One big change, Neeraj, is the flows, liquidity which is coming in from foreign investors. And we've seen a gush of liquidity. The numbers look extremely healthy. So so I think it goes with the current mood, sentiment, and what's happening all around us.
And that's a telling part too, right? So, Nitin, 10 odd days left for the month, let's say 6-7 odd sessions, but we are already circa 40,000 crores, third month on a trot wherein we are over that number, so to say, assuming that this kind of continues despite Friday's move. What's your sense about that particular aspect? Because something that goes on for a while until it turns, right? At some point of time, we'll see this turning.
So look, the way we have often advised our investors is that market corrections are part and parcel of any market, right? And you can expect at any point of time a 10 odd % correction just to come and go. But that's the nature of markets, right? That one has to live with. And that's why equities is such a brilliant asset class to own from a long-term perspective. But here, what we are also saying is, as in addition to whatever Ashish mentioned, is that it is being led by fundamentals, right? So there is no euphoria of the lot that just takes the market into a bubble kind of zone. It is backed by solid earnings growth, backed by fundamentals, and companies getting efficient at cash flow generation as well. Which is why we believe that any opportunity, if we get on a downtrend, will only be a buying opportunity from here on in, as long as your investments go into quality-oriented strategies.
Yeah. The problem, Ashish, that is now happening, and it's a good problem to have, is that corrections are becoming shallower because earlier FI flows dominated, and yes, even now they do because they are large in number, but the DI numbers are very, very strong. So my question to you is, I heard Nitin say that corrections, if any, could be a part, and will it get bought into? How meaty could things become if Indian markets, maybe due to global factors or otherwise, would correct, let's say, between 5 to 10%?
Yeah, so that's a good question. See, obviously it's very difficult to predict levels, but I'm just trying to correlate fundamentals with the kind of levels that we have seen in the past and what is possible in the likely future. Look, what was 16,000 earlier for the Nifty, right? And we had a floor at 16 during the last correction, is now, according to me, 18, right? So you're at 20. So my sense is that the floor is at 10% from here, max. In terms of upside, that's where it gets a little interesting. I believe that 21,000 is par for the course for the Nifty. But if I just correlate what happened in September, October 2021 to where we are today, purely on fundamentals, for the markets to become really expensive, the Nifty has to go to 27,000, right? So that's how I see the market. I mean, typically, just based on fundamentals, the range is somewhere between 18,000 to maybe on the upside. If the market just goes crazy and the flows continue the way they are, you could probably get to 27,000 on the Nifty. But from a risk return trade off point of view, equities are still in your favor in spite of the kind of rise that we have seen in the recent past. And remember, this FI flows that we are seeing, this bunched up flows in the last 3-4 months, are also a function of what happened in the previous 12 months. FIs have been short on, net short on India in terms of flows. So I think there is a little bit of catch up also happening. And the fact that India is one of the few economies where you're seeing economic growth and that translating into corporate profits. Last time, if you remember, we spoke about a hat trick, right? 3 financial years of double-digit growth. And even this year looks like a double-digit growth possibility.
Yeah, in fact, I read your note and I realized that it could actually be 6 years. Because I think one of your notes spoke about how 25 and 26 could also have something like that. I think that's what I remember, but maybe I'm wrong. But nevertheless, the point is, and to either of you can kind of take this, what the flows do is one thing, and what is it that you hear from the ground, both on the domestic side as well as from global investors, is something else. I would love to understand what is it that you guys understand when you talk to people around, because some people that we've interviewed in the last few days have said that we are still not in the euphoria zone, because throughout this rally people have been saying that at some point of time it will correct, let me keep some cash on the sides. Almost every 200, 300 points on the Nifty, people have been talking about, okay, there could be a corrective move coming up. So everybody's not fully in, and therefore it is not a euphoria stage as yet. I'm just trying to understand, how is it that you guys gauge investor sentiment, both local and global?
Yeah, so I'll just take that since I speak to a lot of investors and clients. See, what has happened, Neeraj, is yes, equities, we've had a correction for almost about 18 months. If you remember, from 2021 September to about March of this calendar year. So as a result, as an asset class, somewhere, it was put on the back burner. The other force was also the fact that fixed income yields went up. So a lot of HNI clients were actually busy allocating more and more money in fixed income. And I think this rise in markets also came about very suddenly, and led by FIs and liquidity. And then typically how it works is everybody then joins the party. So you're right that there is a bit of a missed out feeling in this rally, and there is a lot of money still waiting on the sidelines. So I don't see a euphoria really. So today the conversations are more about hey, we want to allocate more, but in front of us, the markets have moved up close to 8 to 10%, and even the mid and small cap stocks have started buzzing. So how do we really go about allocating this capital? Should we do it immediately, or should we do it in a staggered manner? So that is the kind of conversation we are having. So that's why I do believe that it's not really a euphoric kind of a rally or a situation where everybody is allocated and everybody is really waiting to jump in. There is a bit of a missed out feeling already, but there is still a lot of capital sitting on the sidelines, especially from ultra HNI's family offices. Nitin, if you want
yeah, pretty much the same. And I think in a market like this, it always makes sense to adopt a more staggered way of deployment.
Got it. Nitin, slide number 18 talks about private capex on the rise. 2 questions to that. One, thus far, except for select pockets wherein there is government spending, we haven't heard about a full-blown private capex piece per se. So it's not like the telltale signs are there. Conversations with government, we were talking to an economist yesterday who spoke about how traditionally in periods of global uncertainty, large private capital, except for select pockets, never comes in. It only happens when the global economy is stable. The global economy is anything but stable right now. So is it really on the rise, or is it very selective currently?
You're right, Neeraj. As of now, it is fairly selective, but I would say it is predominantly driven by PLI. Now, what PLI has basically done is it has, so the government has already given that check out, right, for corporates to invest. So corporates have no option but to have already put in that deployment into capex. A lot of it you would have seen has already happened in the electronic space, in the auto space, so on and so forth. And that, to my mind, is the biggest driver of capex right now. But to our minds, if I had to just put a broader view on this, think about it this way, that it was only way back in 2003 to 2007 that you had a full blown capex cycle. Obviously at that point of time there was a host of greenfield projects that came on board. But this time what is happening is that you're seeing not just public capex, a little bit of private capex, maybe selective, but also household capex in terms of real estate. Now, real estate sector as a whole has certainly turned around over the last, let's say, year and a half. And you're seeing a lot of velocity and also a lot of inventory, unsold inventory levels have seriously come off. So I think if you look at a slightly broader measure to the capex that we otherwise associate to private, I think you would find that India is certainly coming of age now in that entire cycle.
Okay, let's hope it becomes even more prominent in the times to come. So, and thanks for the clarification. It's good to understand the nuance within that private capex piece as well. Now, you guys look at data, look at the, there's this temperature gauge or this sensitivity gauge that you bring about in all the notes. I haven't had a chance to look at it this time around, but the market's having rallied the way it has. Where does it stand now? What does it tell about the near term?
So as of now, the temperature gauge index is still in the fair zone. Although I would say that it's inching upwards towards expensive, it's still a decent way to go. But what the temperature gauge index does take into account is where interest rates also stand in the system. And today we are standing, if you look at it from a 10-year GSEC perspective, we are, let's say, about 7.07, 7.08 kind of levels. So going forward, if I take a trajectory over the next year or year and a half, we certainly are of the view that interest rates may remain stable and may come off eventually over a period of time, in which case valuations have the potential to re-rate themselves as long as earnings plays catch up. Right. And we do believe that fundamentally speaking, we are on that trajectory where at least for FY24, banking will certainly lead that view. Along with auto and oil and gas. I mean, these sectors are expected to contribute almost 82% to the Nifty's profitability for the coming year. So healthy earnings growth should provide a cushion to valuations going forward. And as and when interest rates actually, trend lower over the next, let's say, 18 months to 24 months, we should be in a much better spot from a valuations perspective as well.
To reiterate, Neeraj, we use the temperature gauge for allocations. So typically in the zone where we are recommending for any incremental allocations, people put in 50% right now and 50% they could stagger it over the next 6 months to 12 months.
Okay, so just a follow up on there and then the follow up on the other piece. But Ashish, I remember, I think, pardon me for not remembering the exact one, maybe it was April, but at that point of time, the call was to be allocated in multiple assets, right? And are the proportions of allocation to equity versus the other assets different than what they were maybe in April?
So in our multi-asset portfolios, yes, the allocation to equities would have gone up purely because of the mark-to-market. But, today we are in a zone of valuation in equities and where the other asset classes stand. If I were to build a fresh portfolio, I would allocate as per plan. I mean, I wouldn't go, let's say, overweight or underweight on any asset class. So we are in that mid zone right now.
Okay, get the drift. Last couple of questions. So I'm just going to get back to the spirit of the note, right? A lot of people get phased or, out by the market having moved higher. So the way you said Ashish, that a lot of people wanted to allocate and couldn't allocate because aankh ke samne markets went up. For a lot of people, because they were allocated and the market has inched up, they get this jitters of should I book out, right? But I'm just trying to get back to the theme that when you're trying to say there is an albatross gliding, which means that it is on a safe, steady path, assuming everything stays constant, it might be a better idea to stay invested as opposed to try and tinker too much with a portfolio? Either of you?
Yeah, absolutely. I mean, that's what I was indicating, that you're in that mid zone where even if you want to deploy additional amounts, you could do it, gradually. But whatever you have, you should stay put because the risk return trade-off is skewed towards the upside on equities at the moment.
Got it. I may have missed out on something because this is an exhaustive note. Nitin, is there something else? There's fixed income, gold. I just thought equities sounded so sexy. Let me not try and tinker around too much with something else. But is there something that I've missed out?
Yeah, the one important aspect that I'd like to add is from a valuations perspective, we often look at the price to earnings, right? By itself, we believe that's not the only measure that one needs to take into cognizance. So we put an interesting study into this month's note, which talks about enterprise value to cash flow from operations. And what we have found is that this ratio, EV to CFO, has pretty much remained the same vis-a-vis the previous peak of August, September 2021. Now, why this is interesting is on two counts. Is let's say from that level to today, the Nifty might be up, let's say about 6 to 7% or slightly higher than that. This universe that we've taken talks about the top 500 companies X of financials. Now, what we've realized that cash flow from operations has more than kept up pace with the index movement. That's point number one. Secondly, you should remember that cost of capital at that point of time was about 6.2% as measured by the 10-year GSEC, which today is almost 90 bips to 100 bips higher. Despite the fact that cost of capital has actually gone up, this ratio of enterprise value to cash flow from operations has remained the same, which tells you that companies have gotten far more efficient. Earnings is the fundamental reason why equity markets are doing well. And in relation to what I mentioned earlier, if cost of capital is likely to trend lower over the next 18 to 24 months, we'll only see this ratio getting better and getting healthier as far as Indian corporates are concerned.
If that were not to happen, would this be a peak for the ratio, or can it still get a bit more skewed on the upside?
Unlikely to get too skewed because we still see a good drift of earnings growth happening. So yes, even if that number inches up, we do believe that it is far away from any kind of expensive zone at this point of time.
Okay. Well, so that statistic plus Ashish saying that if the market were to go crazy, then the number, I don't even want to mention it right now, but could be substantially higher. You know, I'm so enthused to see this because I wrote a column 20 days back saying up ki baar Nifty 50,000, and a lot of people kind of trolled me on Twitter. Now I'm happy to see that I'm actually far conservative when I'm talking about the next decade compared to what the other experts are saying. So thank you, gentlemen, for sharing this wonderful note, giving me one more term in my vocabulary, and for sharing these insights with us.
Yeah, thanks, Neeraj.
Thank you.
Always
so
a pleasure.
The pleasure is entirely ours, gentlemen, and viewers. Thanks for tuning in.